joining CII Startup Buzz. We have been doing this for a couple of months now, every Thursday, 5 p.m. A topic which is relevant, interesting, and absolutely a must watch. Put your clocks, put reminder every Thursday 5 p.m. CII Startup Buzz. I am so delighted today that I have our friend Robin. He's very active in CII. He never says no whenever we request him to moderate a session. And thank you, Robin, for agreeing to moderate this session. We are truly delighted to have Ritesh. Thank you, Ritesh, for joining. He's going to speak on a very important topic, three tax issues every founder should know. So, with that, I'm going to hand it over to Robin, but a reminder again, set your clock every Thursday, 5 p.m. You can watch our past sessions on our YouTube link, CII for Western region. Go there, you can see all that. Our intention is if you're whether you're a founder, whether you're a professional connected to the startup ecosystem, whether you're just a person interested in these topics, VC, investor, angel, whatever minutest connection you have the startup ecosystem at CII, our endeavor is to have an entire library where you just pick up a topic and you get it. So that's the endeavor with Startup Buzz. And thank you again for joining. Thank you, Robin and Ritesh. Over to you, Robin, to moderate the session. Thank you.
Thank you, Nina. Thank you, everyone. Good evening, good afternoon, good day, based on at what point of time you are going to seeing this um, podcast. Thank you, Ritesh Kumar, who is with us to explain to us the tax-related issues on startups. Now, startups is obviously something which starts from zero. There wasn't anything. And then you create something which is 0 to 1. There is no business on earth which did not have a startup. Every business, howsoever large it is, would have definitely started somewhere. We have Ritesh Kumar. Ritesh is a chartered accountant. He has more than 17 years of experience. He is working with and he's a partner with Dhruv Advisors. He is a tax advisory guru. He has been doing M&As and working with startup system for a long, long time. He has been in various committees and subcommittees, including he's currently doing for the country the model tax code for India's private equity and venture capital industry. So thank you, Ritesh, for joining us and explaining your views to our viewers today.
Thank you,
Ritesh, would
Robin.
you like to say a few words about yourself if you want to?
No, thanks, Robin, and thank you, Ninad and CII, for giving me the opportunity to speak to such a wide variety of audience. My journey with startups really got kicked off back in the day when I first joined EY as a young associate. And our partners at the time were looking at how could a startup with a multi-purpose e-commerce business idea in mind, how could they raise money in this country? What are the pros and cons? How does it work? So, going back a long time, I've been working with the startup ecosystem for close to 15 years now. We've seen a complete life cycle or two, perhaps, of raising capital, exits, and now more interestingly, the IPOs. Have been really blessed to work closely with the venture capital industry in India and then progressing into the private equity industry.
Thank you, Ritesh. My dear viewers, we are supposed to discuss three things which affects a startup ecosystem when it comes to tax. We have chosen three. We could have obviously chosen 5, 6, 7, 10, 30. One, we would be talking about when you decide startups from tax angle, where should you set up? India, Singapore, tax havens. This is one aspect we will discuss. Second, what we will discuss is what happens to in the startups ecosystem, stock linked reward system. It's a startup, it's a business that's just started. It may or may not be listed. Chances are that it is not. And how to incentivize employees, consultants, owners, etc. That's a second aspect. We would also discuss what about exiting? What happens to the tax aspect when the owner exits today, tomorrow, day after? So these are the three things we will try to cover. We have about 40 minutes to cover, Ritesh, and we can be brief. We will have some question answer session also if we can. So Ritesh, if you could kindly explain to us that when a startup is getting set up, of course, many a times we think that it would be nice to set up in Hong Kong or Singapore or Dubai. Dubai, of course, there's no tax, or maybe India. Could you, from tax angle, explain to us what should be considered while setting up a startup or startup company?
Sure. I think, Robin, it's a very interesting question and a question that has remained relevant over the last 15 years or so. More so often when you meet a startup founder for the first time, he's got a great idea. He or she has a great technology platform or a great execution platform that they've built over time. And and in this process, it's very important for all of us to understand why the choice of jurisdiction becomes particularly important. More often than not, we will realize that the choice of jurisdiction is also important from a commercial perspective as much as it is from a tax perspective. But consider a situation where you have a SaaS product company where you have a technology product that can be sold to that can be sold to buyers and users outside India, the core of which is not something that serves necessarily only the Indian market. And in these situations, a question comes up on whether do we have a structure like you alluded to in Singapore, whether should we have a structure in the US, what are the attributes that define for me to be in that particular country, serving the local customers there. From a tax point of view, there are two segments in which one could break this. One is in how the operating income, how the operational ease of that particular line item in the income works. And the second is how do you look at it purely from a strategic capital raising perspective? Which country offers a larger pool of investors? How do valuations play out? What are the pros and cons relative to each of them when it comes to an exit situation? So, over time, an offshore structure typically tends to work better when you have offshore customers. Your business is predominantly technology driven. And in those cases, an externalized structure, let's say in a Singapore or in the US, tends to work far better from a tax and from a strategic point of view. But let's say your business idea involves having to work with Indian consumers. Let's say you are a B2B player who's serving Indian consumers. Then very likely, or even a B2C player which is serving Indian consumers, then very likely the advice you will receive is to set up an Indian entity, at least for operating their businesses, operating the larger framework of your business in India. But even in these cases, it's not uncommon to find examples where they've set up their operating companies in India, but for capital raising activities, for various strategic initiatives, they've had an holding entity of sorts which is based outside. And so far, the common choice of jurisdictions has been between Singapore and the US. You will find Flipkart being one such example of it. They run a large e-commerce B2B to C platform in this country, and traditionally the entity is held in Singapore. We've been reading a lot in the news that Flipkart wants to now come back into India from a holding structure point of view. And that is really, the kind of differences you will find, because back in the time, raising money overseas could have been far more easier. India still has a fairly tight exchange control law, which restricts the form, the manner, and the nature of commercial arrangements an Indian entity can enter into. So, Robin, really, the answer to that question is it is defined by what is the nature of business you're doing, where do you see fundraising happening, how complex is fundraising, and what are your primary tax considerations when you have to operate in any of these countries.
So, two considerations for, if I have understood correctly, two considerations for keeping in mind when we start a startup with jurisdiction. One, where the capital will be raised, or there are the possibilities of raising capital. And you did mention Singapore and USA looks to be quite attractive. Payment of tax, of course, I always believe that if we are earning $100 income or profit, why don't you pay $30 of
Yeah.
tax? So payment of tax perhaps is secondary. Sourcing of money is primary for setting up the jurisdiction that the startup should be founded. Is
And
this a
operational
correct way?
efficiency. Yeah, and also just add a layer of operational efficiency because see, in a SaaS kind of a model, having contracts between two US enterprises is far more easier. Your IP protection regime is far more exhaustive in the US as compared to what India tends to offer. So sometimes these elements play a much bigger role. I'll give you an example. We were talking to a digital identity based company in Bangalore, and one of the largest customers was a South African customer. And in India, when you end up having banking transactions with some of these odd South African countries, banks are not as comfortable. They tend to ask you a lot more questions. You have limited flexibility to open a dollar denominated account. So with them, we had to, by compulsion almost, advise them that they should have an offshore structure because otherwise running the business efficiently from an operation perspective becomes very, very difficult.
Wonderful. Understood. Foreign exchange are again another issue which needs to be considered, availability or otherwise usage. I move to the second question, first being where should jurisdiction be to set up a startup? The second is how do we incentivize people? Now, there are three sets of um, people or stakeholders. One stakeholder is, of course, the owner. Second stakeholder are the employees. The third in a startup ecosystem are the consultants.
Right.
And in this incentive system, can you explain how stock options or ESOPs or stock linked incentive system, can you explain to us that how best is to make it play so that we are efficient and of course we incentivize our stakeholders? Over to
Yeah.
you, Dave.
Yeah. I think Robin, it's you've got the biggest issue out. It's always been a challenge for us when it comes to stock linked incentives, like you rightly pointed out. Uh, 80% or 90% of the startups roughly said so. At some point in their journey, really have to think about how do I use stock as a incentive to attract either the right talent, many a times the right advisors, because one of the significant limitations when you start off your own business, you may have managed to raise a small amount of capital either as a seed round or a series A round. But you have to then use your cash extremely judiciously. And as anything would tell us on from the past, the stock linked rewards have played a significant role in making sure there is right talent and there is right advice. Unfortunately, under the Indian law, uh, giving out stock linked incentives has come with a fair bit of a regulatory framework around it. Unlike in the US or else, or perhaps also in Singapore, where you can and you have the flexibility to issue stock linked rewards to people who are not even your employees. Under the Indian law, there is a limitation to only issue stock linked rewards to your employees. And broadly, when you look at stock linked reward structures, we've seen about three or four kinds of them playing out. The most common of all, of course, is to give equity directly to the employee as a part of the ESOP scheme. In this, it is a plain and simple ESOP scheme that is rolled out by the Indian company. All employees of the startup company participate in it. There is a concept of a strike price, the price at which you offer equity to the employee, and over time, and if you want to make it conditional, your ESOP scheme grants or vests, as they call, benefits to the employees. But as some of these structures have played out, as businesses and as transactions have got complex, we've also seen a lot of our clients look to issue ESOPs, but not to the employees directly. They use a trust mechanism to administer stock options, because as the business grows, I have, let's say, 1,500 employees in India. Each of them have entitlement to stock, and when I want to sell the company to a strategic buyer, I can't make 1,500 people party to a transaction which is otherwise a private transaction between two transacting entities. So many a times we've seen that with the growth in size, they use a trust structure to administer how stock options are given out. And on the advisors front, given the restriction under the Indian law, you can't issue them shares either through a stock option plan or otherwise, or meaning otherwise under the trust. So we've seen a fair bit of usage of what we call the phantom stock option. A phantom stock, like the word describes it, is absolutely non-existential in its form of a in its form of a security, but it is a contractual promise that I, as a startup company, will make to you as an advisor, that I'm going to give you as much value as you would have derived if you held, let's say, 100 shares in my company. It is a contractual promise. It is not a promise that is represented by actual number of equity shares in the company. This is a little bit disadvantageous when it comes to tax, because any gain or any proceeds you receive from the phantom stock option promise is taxable as ordinary income, which in today's day and age has a fair bit of tax rate arbitrage. Capital gains income is taxable at 12.5. Ordinary income is taxable at 30%. And in some cases with surcharges and cess can go up to 39%. So it's not the most tax efficient method of doing it, but you still have a contractual promise. You're still deriving wealth in participating as an advisor with a startup. And lastly, Robin, if I may briefly touch upon, you have increasingly a trend that is picking up in this country, which is looking to incentivize employees and participants based on which business they work with, right? So take an example of a B2B company, which is also running a lending arm within itself. Let's say it has a NBFC housed within the larger setup of running the B2B operations. The growth parameters, the valuation considerations for an NBFC could be very different from that of the primary entity which does the B2B business. And we are now being called upon to address this challenge, where clients have asked us, can you find us a stock option plan that gives an upside to the employees of the NBFC in relative terms, in direct correlation to the growth they bring in the NBFC, and not just linked to the growth of the overall valuation of the business group. So look, variety of these structures have existed over time. And much like startups like to innovate on their businesses, they've also found some of these innovative structures, and they found innovative ways to compensate their employees.
I have a quick follow-up question just to clarify for everyone else. Um, Now, when you are saying we are giving stock option is a value, and typically a startup is not a listed company. So, how does one employee know what is the value of gain he or she is getting? And is it worth it, not worth it? How does that happen?
Yeah. So, Robin, I just take a step back to quickly give you all an overview of how what is the life cycle of a stock option, right? So, right, like you rightly said, the first stage involves a promise, right? The first stage is when the startup company is making a promise to its employee that it would issue to the employee, let's say 100 shares in the future, provided the employee has stayed on with the company for a certain duration of time. With passage of time, and usually you see 4 years as the period in which your options get vested. With every passing year, one part of this promise, which is subject to the condition, becomes unconditional, which is to say that with every year, I have a right, an enforceable right, in which I can go to my employer or my startup company and ask them to give me shares. And the way valuations interplay in this at this junction is like I briefly spoke of before, there is a certain price at which the companies may offer stock to the employees. And more often, that price is zero in today's day and age. But the value of the company has been established. Now, the value of the company, how does it get established, is addressed by what a third party investor investing into the company believes is the value of the company. So it's not as arbitrary or vague as one would consider because the stock is unlisted. You have tested market price that is given out by a third party on which you place a reliance. And and to that effect, therefore, the valuation in a startup is also reasonably scientific. We've all seen periods where valuations were some of them believed valuations were unrealistic, they were overconfident. But the same thing with the listed markets, right? You'll have points where Sensex is outperforming any other asset class, and you'll have points where you'll have situations where Sensex will not outperform. But coming back to the context of the discussion, pricing is market linked and market determined by investors and everybody else who's out there. As a employee in the startup, your commitment to whether or not acquire equity at this stage, you had a right, you had an option, the option became a right, and now the choice you're making is, do I get this equity or not? Once you get the equity, the fair market value of the equity and the price that you pay, the difference between the two is the value that is subject to tax in the hands of the employee. And under the Indian tax law, the additional layer of ring fencing, in some sense, that the legislatures have added is to say that please procure a valuation report from a merchant banker who has to independently assess what is the value of the company. So the tax liability is determined basis an independent merchant banker's report on the value of the company, and does not necessarily have to reflect what is the value that you hear in the newspaper about at which the funds have been raised or anything else, right? So the tax law provides for a protective mechanism, knowing that this uncertainty may exist, right? So at this stage, when you when you sort of come into the play, when you're asking equity from the employer, you pay this tax when equity is getting allotted to you. This is popularly referred to as the perquisite tax. And once the perquisite tax is paid by the employee becomes a shareholder of that particular startup. And once you become a shareholder, your life cycle begins under the capital gains regime, which is to say that I have bought shares. I have now got shares in my startup company. I hold them beyond 2 years period, and then I sell it and when I sell it to an investor or in the secondary market, The difference there again is payable as capital gains tax.
Now, here I have a question that, as you said, that normally the shares are stated that you will be given at zero value to start with, and then there is a valuation. Let's say it's zero today, and then I get shares from the company as ESOP after 2 years, and there is a PE deal or a JV deal or a third party deal where the value of my share is now 200. So I
Right.
had zero at which it was given to me, but now based on third party valuation, it is 200. I go to a merchant banker. Merchant banker gives a valuation, let's say 175. My first question, I have two questions here. That the public value is 200 because that is at which investors are investing. And merchant banker says it is 175. So will 175 prevail or 200? Question number one. Question number two, at what point of time will the employee be liable to pay the tax? That
Sure.
means I am vested with the rights after 2 years, but I'm not selling the shares. I may
Correct.
sell the shares after 3 years. Am I supposed to pay the capital gains tax, short term or long term, on the second year itself or when I'm going to sell? Can you please explain these two?
Sure. So, Robin, on the first question, between 175 and 200, a very clinical answer would be to say that law requires a merchant banker's report. And what is therefore required to ascertain the value of the perquisite is the merchant banker's report. By that analogy, therefore, 175 should prevail over 200. And to that effect, there is that little bit of an arbitrage that is created. Uh, on the second question, uh, let's run this with an example, perhaps, right? So, like you said, when I got stock, I was asked to pay nothing. Zero is my cost for the equity in the company. The company was valued at 100 rupees, or my portion of the equity was valued at 100 rupees. And on 100 minus zero, which is 100 again, I have paid perquisite tax, like I just explained now. Perquisite tax is payable at the rates which are otherwise used for determining tax on your salary income. So therefore, let's assume 30% is that rate. So on a 100 rupee benefit you've received, you've paid a 30 rupee tax. And the challenge here, and this is where the biggest challenge in the ESOP ecosystem is, that you have to, as an employee, shell out 30 rupees in cash when really you only got benefit on paper. The benefit is not an actual cash benefit like a bonus payment or something else which is reflecting in your bank account. And to address this specific concern, what the government has done is they've provided some form of a deferral mechanism. If you have received a benefit of ESOP from a company which is registered as a startup, then this tax of 30 rupees can be deferred for a few years. Uh, and in that period, so you can choose a deferral period of 5 years. And in that period, the tax department cannot come and collect 30 rupees from you. Let's and so that said and solved, then you become a shareholder in the company, and the cost for your shares in the company is now reset from 0 to 100, because the law says having paid tax on 100, your cost of acquisition becomes 100. And let's say this company was to do an IPO 3 years from then, in which case 100 in the market fetches you 1000. You will pay tax on 1000 minus 100, the 900 incremental gain. You will pay tax on this 900 at the rates of a capital gains, whichever is applicable at that point in time. Today, the long term capital gain rate is 12.5%, increased by surcharge and cess. It inches closer to 15%. So, on the 900, you are liable to pay a 15% tax, which is, let's say, roughly what, 135 rupees. And if you look at the totality of the cost of tax, having received a 1,000 rupee benefit by participating in a company stock option plan, your cost of perquisite tax is 30 rupees and the cost of capital gains is 135 rupees. and your total tax cost becomes 165 rupees. So that is really how the tax costs play out over the life cycle of a stock option.
So a clarification again that if the stock option is vested and the employee is not selling the shares, he or she can defer the tax payment.
Yeah,
Is it for 5 years he can defer or she can defer? Or
yeah.
she has to is can you explain little how much is the
So
deferment?
you can defer it for a specified period. I think the period specified just now is about 5 years.
Okay.
But the challenge there, and it's an interesting point to bring out, Robin, is while there is a deferral, there is really no exemption from interest being accrued on the tax component that you're deferring. So, just as a very fundamental principle under the Indian tax law, when tax is not paid on time, you end up paying interest at 1% a month. Now, while you've been allowed to defer the quantum of tax paid, you are not given an exemption from interest on that. So when you discharge this liability, ultimately in year three, when you sold this equity share, you got cash in your account, your cost will be increased by the cost of interest on the 30 rupee in our previous example.
Got it. So therefore, the vesting, the date of the vesting of the shares to the employees is very important
Yeah,
because something or the other will kick in. Either the capital gains tax itself, or if the employee wants to defer it, he or she will be liable to interest on the deferred tax
absolutely.
liability.
Absolutely.
So
Absolutely.
it's not a free lunch.
Is not a free lunch, and this is the biggest flaw, if you ask me, in our tax code that works as a deterrent to a startup doing a ESOP structure.
Okay, good. Um, there are questions are flowing in, Ritesh, just for information. But we
Sure.
will take the third question, which we said mentioned that we will answer three things today. And if we can take the third one, which is the exit mechanism.
Absolutely.
Now, the Zomatos of the world and the Lenskart of the world has now made startup entrepreneurs rich in the billions of dollars. They've all become unicorns. There's so much money in the market. So, having said that, what's the best way to exit, and what are the guardrails which should be kept in mind initially? Is that should there be exit after 5 years, 7 years, 10 years? How should it be handled? Any
Sure.
quick advice for that?
Sure. So, Robin, quickly, the ground check on reality is that no investor who gives you money gives it to you forever. There is nothing called as perpetual capital in this space, right? And as all of us are familiar, each of us, each of the investors we are working with or talking to, have also raised money from their investors in turn. So there is an inherent limitation of time that comes along with this fiduciary role of taking somebody else's money and investing on their behalf. Uh, India has experienced a standard of 8 years, where typically in between 5 and 8 years, the investor who's invested in your startup company wants to seek an exit. And like you rightly pointed out with the examples of Zomato's or Lenscarts of the world, there is a fair bit of traction and conversation on whether at all as a startup company who may or may not be still fully profitable, but has a certain amount of traction. What are the avenues that open up for me? How do I offer an exit? How do I seek liquidity? And in this, really, you have three key methods, if you were to sort of loosely call them. Three key ways in which a startup founder can, look at giving exits. One is what we call the strategic sale. This is an example of where you have identified and made a product which happens to fit so well into an industry peer, a larger industry peer, which therefore you don't need to then and which therefore the larger industry peer, the strategic player, will then buy you out, and you don't need to go through the process of listing or anything else. Take the example of Hindustan Unilever in India when they acquired Minimalist, right? So Minimalist was a startup which was doing skincare products, niche skincare products. Hindustan Unilever wanted it as a part of their product portfolio, paid a very hefty, fancy price for the products, and therefore Minimalist never saw the day, or never saw the light of the day in the IPO market. Now compare this to something like the examples that you led with Zomato or a Lenskart or a Paytm or any of the others. What have they done? They've created products, they've created businesses that stand on their own, right? And some of these businesses, not to say that strategic players were not interested, but found better opportunities when they were to be offered into the public market. And the choice between a strategic sale versus an IPO sale is something which is extremely commercial, extremely sensitive. Invariably, investors and the founders sit together and take a call on what needs to be done. But look, IPO is a reality today, right? And startup IPOs have become a reality. There is a fair bit of money that is at play in this country when it comes to listed capital markets. May not be a apple to apple comparison, but there was some news article suggesting that the LG Electronics IPO was subscribed at the pace of $200 million an hour. So just imagine the kind of liquidity Indian market is holding today. And to sort of go back a couple of minutes into our conversation where we spoke of what is the right structure for a startup. Should it be in India? Should it be outside India? Uh, you know, and you sort of mentioned the example of PhonePe at some point. All of these have been traditionally externalized structures. These were all companies that had their holding entities in Singapore, but for the purpose of giving an exit to their investors, they've now come back into India, which is the concept, and the colloquial term is ghar wapsi, as the government describes it. Ghar wapsi again is a very real phenomenon. We are seeing an increased number of these companies flipping back into India, accessing IPO markets. So it's been more than encouraging to see such large number of Indian startups wanting to come back to their homeland and wanting to access the capital markets here. Now, what are the key guardrails? Because a lot of these exits involve a fair bit of structuring, and many of our startups today have been in their existence for more than 10 years. Investors are fairly cautious on what kind of tax positions they are adopting when they exit in a particular startup. Because as you must be aware, treaties like Singapore Tax Treaty or the Mauritian Tax Treaty don't tax gains which have accrued on investments made before 1 April 2018, right? So all investments that some of these global investors made into India uh, are completely tax exempt, even if the treaty has changed since 2018. So that those, from an investor point of view, that's a very critical aspect of evaluation. From a founder point of view, what is their cost of tax? What is their regulatory cost when they sort of participate in an exit? That's another area of interesting conversation we're having with a lot of mature founders in this country today. And slowly and slightly moving into the employee section, take a situation where uh, you had a company which was set up in Singapore, you had stock options in Singapore, but now there is a ghar wapsi that is happening. How will my equity look in India? Will I start the clock back at zero? Will I get the benefit of shares in the Indian company upfront without having to do anything else? So, Robin, a wide latitude of issues on exit. In fact, much more on preparation for exit rather than exactly at the exit event. One needs to really very carefully navigate these issues today.
Wonderful. Thank you. So we generally talked about three things. We talked about where the company should be set up in startups. There is no clear winners except for the fact where the money is getting raised and ease of doing business perhaps drives the case rather than India. rather than tax itself. As regards stock options and are concerned, I think the valuation is there are tax liabilities when there is ESOPs and stock options are coming through. There are some deferment possible. Exit is something which one can plan. Again, another issue here is if there is a ghar wapsi, again the clock sometimes goes back and we need to think through what will happen. Having said that, there are several questions, and I'll try to club it together. What are the most common tax mistakes an early stage startup makes when set up their business startups? You have to be short, Ritesh, because there are several questions we have to answer in
It's a
5 to 7
one-word
minutes.
answer, Robin. I think the biggest and the most common tax mistake we see in early stage startups is taking compliances lightly. I think, we empathize with founders. They have a bunch of things going on in their lives in terms of getting the product fitment, market acceptance, and all of the other things. But nothing underscores the importance of doing it in the right manner, do the right compliances, do the right reportings. Nothing is more important than that today.
Wonderful. In fact, another question which comes here is that what should the startups do with regard to GST and other indirect taxes? Where I presume your advice will be don't lose sight of GST, don't lose sight of the taxes which you have to pay, and keep that in mind. Any advice you have?
I 100% echo what you just said. Look, it's not, and more often it's not the big things that cause the damages. It is the small cracks when they're ignored as you're building up your foundation that will cause some of the largest damages, right? And GST is one such element in the room because it's an admitted liability on you, right? Whether you're selling goods or you're offering services, uh, there is no escaping from it. But more often than not, we see, genuine errors, right? Just innocent errors that come in the process that causes a little bit of an issue as the business is growing. So you're completely right. You have to focus on how you do GST, TDS, tax collection at source. All of these are small things, but the more you put the discipline of doing the small things right, as you grow, it only replicates and it only makes life easier for all of us.
Wonderful. There is an observation here by one of our viewers that what are the implications of issuing ESOPs and how can startups manage related tax challenges effectively, which I think Ritesh should explain very well, the tax challenges of ESOPs. If I have to take away one sentence, that when ESOP tax challenges, we have to think through what is the vesting date, because moment an ESOP is vested, willy-nilly there is some tax liability comes on to the vested employees or the owners or the consultants, whoever the vesting is. So the vesting date needs to be chosen carefully so that no unnecessary tax obligations burden come. Is the right understanding, Ritesh?
Yeah, just one very small correction, Robin, is merely because a stock option vests on me as an employee, I don't have a tax liability at vesting. The liability crystallizes when I choose to convert my vested option into the equity of the company. So only when I choose to convert do I have to pay taxes and not otherwise.
So my shares have been vested. I have not converted. As long as I don't convert, I am
Abs-
saved of tax liability.
Absolutely.
Wonderful. I think
But
that's a
sorry,
very
I just to one small commercial aspect I would like to highlight is, the longer you delay the exercising of your option, just bear in mind that the fair market value of the company is going up continuously. So every time
hopefully.
you compute, the base on which you pay the 30% tax is also growing.
So it is the timing when you want to actually take charge of the shares,
Absolutely.
vis-a-vis should I take it later on and maybe take the risk of higher valuation and paying higher
That
tax.
is correct. That is
Wonderful.
absolutely
What a great problem the employees could have, whether
correct.
I should become more rich today or richer tomorrow.
Yeah.
What are the key tax considerations during fundraising rounds? When we are raising funds, what are the key tax considerations we need to keep in mind? Could you just give one or two ones because we are running out of time?
Sure. I mean, the question is vast enough for us to spend an hour on it. But really, if you were to look at the top two issues, uh, what is the pricing at which you are issuing, at which you are raising capital? We've had instances where investor A subscribed to an instrument at a price lower than that of an investor B. How do I deal with this differential pricing? Or to make things slightly more complex, if I had investor A as an angel investor, Robin as an angel investor in my company, and I have, let's say, a large VC fund wanting to invest by buying out Robin's stake, in addition to also infusing primary capital. And if the secondary, that is buying of the shares, was to happen at a discount to what is the price I'm paying for my primary. So some of these are sort of real burning issues that we encounter on a very regular basis when we advise clients on raising capital from institutional investors.
Wonderful. There is one question which is follow up to the GST question that one of the viewers is saying that what are the top three areas where startups often go wrong in GST and TDS compliances? My experience says, and I would like you to say that's right or wrong. I think the startup, and we have already mentioned that the entrepreneurs takes it very lightly. They are too busy with many other things. So they have not paid the GST liability which they would have collected from the customers, nor paid the TDS from the employees' taxes. They would have deducted the TDS, but not paid to the government. To my mind, these are the two. Not paying the due taxes to the government is the single most important issue which a startup entrepreneur must be taking care of. Any views on this?
Yeah, I can't agree with you more, Robin. I think it's very important that what taxes you're collecting, please deposit them. Don't hold them back and use them as working capital. But I'll just give you two quick, very principal issues. And whoever is a viewer who's asked this question, I think it's important to quickly address it. On the GST side, more often errors are found in two aspects. One is you've not discharged liability under the reverse charge mechanism just because you didn't know that reverse charge mechanism applied on certain kinds of transactions. Second is I have taken input credit for all inputs that have accumulated in my business, not knowing whether it's an eligible input or an ineligible input. And that gets disastrous as the scale grows. On the TDS side, I think the single largest issue we are facing is withholding of tax under 194Q. This is really a new thing where the government has asked to withhold tax at 0.01% when you buy goods or you buy a certain specific list of items. When you buy such specified goods or services, sorry, not services, when you buy such specified goods, you are required to withhold at 0.1%. And again, through out of innocence or lack of the right advice, you have startups who end up not withholding, facing the wrath of the tax office for an amount that is so insignificant, but merely because you've not followed the right things, right? So these two things in the GST regime and one in the TDS regime, most common issues than otherwise.
Wonderful. A quick question. How about sweat equity to senior management employees? Now, to my mind, sweat equity is nothing else but some sort of release of any advice you want to give on sweat equity, wanting to distinguish from the startup equities which we talked about?
I think the complexity of how do I give stocks to my CXOs who don't want to be given stock as options because stock options are slightly tax inefficient in their hands, and the CXO group tends to carry a significant amount of the benefit under the allocation that happens. Plus, what happens if a promoter wants to increase his shareholding in the startup? Let's consider a promoter who's possibly feeling excessively diluted as a matter of raising primary and secondary rounds of capital. How do you bring him up on the cap table without having to incur a significant amount of tax cost? Uh, Purely because just remember the value is all in the paper. There is no monetized value that is coming his way. So these are perhaps distinctions to what we discussed as a primary ESOP scheme. But a very complex answer, Robin. I don't think at this point we should delve into it.
I think we have answered almost all the questions in some form or the other. Um, what are the one which I can see is what are the key tax considerations when planning an acquisition or preparing for an IPO? Would you kindly
Yeah.
talk about? That's a big
Uh,
one, I think.
Yeah, it's a big one, and it's the most relevant one in the current scheme of things. In IPOs, we are seeing a fair bit of sharing of the upside by the investors to the founders and the promoters. Where investors have said that, look, you've outperformed. We are happy to give you a part of our profits to you, which is what is called the upside sharing arrangements. SEBI has a fair bit of regulation on how you look at upside sharing arrangements. That's one of the biggest things. From a company perspective, what is your track record? Are there any significant tax issues that you should disclose in the DRHP as a risk factor? Where do you stand on that? Because once you get listed, any material tax matters will need to get, publicly disclosed as a part of the Regulation 30 disclosure under the, post the listing. So, again, a wide latitude of issues there, multiple aspects. Should the founder consider setting up a structure which is like a family office like structure before he offers his equity in the IPO? How do I structure my minimum promoter contribution in the IPO? The biggest of all the questions we are facing, do I even need to offer myself as a promoter led company, or should I offer myself in the market as a professionally managed company? How do I navigate some of those issues? Because, really, if you are a promoter led company, there are certain lock in restrictions on the promoters, etc. So, like I said, wide variety of issues, cuts across tax, cuts across regulatory frameworks of exchange control. We had an instance where a promoter was an Indian guy. He was in India while he invested and started his company, and 3 years later moved to the US. And it's been 12 years since he's in the US, has not come back. He's got a citizenship there. He's got a green card citizenship there. Now the investment in his startup has become a non-repatriable investment. While he has a couple of thousand crores that he'll make in the IPO, but how do I then repatriate this money out of India? What is the right thing to do on that? So all of these are issues, and depends on which business you are in, what stage of your company you are at. Wide variety of issues to talk about.
Ritesh, thank you. I think people have been very happy with your comments and guidance to everyone. It's a large issue to box it in 15 minutes to say everything is not obviously feasible, but you
Yeah.
have given a fair bit of ideas as to what is going on in the ecosystem of startup. India is now one of the biggest startup ecosystem in the world. And of course, tax is slowly becoming important in the minds of the entrepreneurs as they're making more and more money. Well, thank you so much. It was absolute pleasure and honor to be speaking to all of you, ladies and gentlemen. Um, I
Thank
think
you, Robin.
most of the questions which I have been able to see, we have tried to answer. Any final comment, Ritesh, you would like to leave for our viewers?
Uh, it's a part of our philosophy at Dhruva. And I say this very fondly and learned it from Dinesh himself. He says, look, tax is a tail to the elephant, and you should never allow the tail to wag the entire animal, right? So, yes, tax is supremely important. It determines IRRs, it determines carries, it determines a lot of things. But I think the largest of all is respect the commercials of every transaction, do the right things. It's hard very often to do the right things, be it on compliances, be it on structuring, but doing the right thing, not letting the tail wag the elephant, is the most important principle that one should live by. And if it means you need to speak to more than one person, please do, please do. It always pays you off. And yeah, I mean, nothing more than saying be careful when you're dealing with tax or with the regulatory items. And Robin, for those of them who felt that some of their questions were not answered, I'd welcome some of them if they want to send me an email. More than happy to be addressing some of their questions or email. No problems at all.
Thank you. Thank you, everybody. Thank you, Ritesh. It was wonderful talking to all of you. Thank you so very much. We are definitely much more um, knowledgeable in the tax area of startups. Thank you so much. Thank you all of you.
Thank you all. Have a nice evening. Thank you. Thanks, Robin.